Welcome back. Why do we even need stablecoins? What does the word stable even mean? Let's find out. We're here plotting the Bitcoin price chart from a time frame before 2014 to nearly today. And you can see that within this time frame of a few years, the price of this asset changed considerably. Certainly, it's a currency. There are millions of people using it, trading it, using it to purchase goods, to buy services, but it's highly volatile. Like a few years ago, it was like near to zero. Then you can see here the significant volatility change, as well as in the recent months. So stable coins really come to kind of create cryptocurrency assets that are at least less volatile. So you might ask, what is stable? What does even stable mean? How can I quantify the meaning of stable? And I don't have a perfect solution here for you, but I would say it's a rather relative metric, right? It's a metric that's relative to other assets. So volatility could be, for example, measured in the standard deviation of returns, right? And if this number is somehow excessive past a certain threshold that you set yourself, then you could say that's an unstable coin. Or if it's below a certain threshold, you could say, well, it's maybe a stable coin. You could also consider the worst drop over a given time frame. And here again, it's really up to you to choose a time frame that you deem appropriate, but it's a rather subjective way of measuring the stability. We can always resort to looking at the volatility of the euro or the pound or the US dollar, and these are so-called fiat currencies. They also have a decent and reasonable volatility of about 6 to 12%. But volatility alone does not capture the range of prices. So at the end of the day, what you deem stable might not always look as stable. In cryptocurrencies, there are a variety of stable and so-called pegged coins that we have looked at earlier already. I think the most famous stable coins that represent the US dollar are these three: USDC, USDT, and DAI. USDC and USDT are reserve-based stable coins where you have a company that has a bank account, and here this bank account should represent the on-chain minted cryptocurrency assets. These cryptocurrencies might perform fractional reserve banking, as we've seen earlier, but this depends on the individual stablecoin token. DAI is an example of a collateral-based stablecoin, and we will also have a brief look at an algorithmic stablecoin in a few slides. Similar to stablecoins, we have pegged coins. So wrapped Bitcoin is representing Bitcoin on another chain. So it could be a token representing Bitcoin on a non-Bitcoin chain. It's not stable per se, but the wrapped Bitcoin token should be stable compared to the Bitcoin price. So they should be one-to-one ideally, right? If they're no longer one-to-one, then we call this a depeg. And there are a variety of other assets, like RenBTC is another BTC pegged coin. There are pegged coins for Ether, like the S-Ether or ST-Ether. If you look at the current rankings as of 2021 on stablecoins on Ethereum, you can see here how many stablecoins worth of US dollar were minted, at least according to these metrics. And you can see here the top ranked stablecoins, USDT clearly being the first, USDC second, BUSD, DAI, and PAX. You can also look into how much was actually minted, so the financial value in US dollar that was minted on chain in this particular stablecoin. And you can see a few other metrics, such as the number of active addresses in the last 24 hours, the number of transactions, and the transaction volume. Again, back to the question of what is stable or what is not stable, I would like to draw your attention to an inflation calculator. So this is if, for example, in the year 1980, right, you purchase an item for $1, right, then in the year 2021, so this year, that item would cost $3.32. So there's a cumulative rate of inflation of 232%, right, over these 41 years. So that's quite significant. So you might say, well, this doesn't look stable to me, right? So over a longer time frame, especially fiat currencies might not look as stable. And you might be alerted that the current inflation rates are quite higher than the envisioned 2%. So currently we are, at least on the US dollar, above 5% inflation, which is much higher than the envisioned 2% regular inflation rates. So stablecoins may not be that stable, but relatively more stable than other cryptocurrencies. I'm not a big fan of such qualitative statements because we don't have any quantitative data here to show you, at least in this statement, but it's still something to consider when discussing stability in general. So now we have a bit of a background. Let's dive into how stablecoins work. Stablecoins on the current smart contract enabled blockchains. So we will look at 5 stablecoins specifically, one which we have already seen, MakerDAO. We look at Synthetics, Ample, USDC, and USDT. So as I've already explained in an earlier lecture, so stablecoins, the MakerDAO system is a stablecoin mechanism that allows you to deposit Ether to open a collateralized debt position, CDP. So what you do is you take 100%, 150% of collateral at least, right? You shouldn't go below. And then you're allowed to mint 100% of the debt. So the debt is being drawn in DAI. So you have a contract. If you give him like a certain amount of Ether, this contract will give you a certain amount of DAI in return. If you pay back your DAI, so if you pay back your debt at a later point in time, then this contract will unlock your Ether on your behalf. So that's a very simple mechanism of how to create a US dollar backed stablecoin in this particular example. Synthetics is another packed or stablecoin mechanism in which you actually can mint any derivative asset. So you could, for example, mint a Tesla share or a representation of a Tesla share. So in the first step, you provide, instead of Ether as in the previous example, you provide SNX as a collateral. So the SNX that you deposit in the contract is then needs to represent 600% of the collateral to mint 100% of the derivative. So you can already see the financial efficiency of Synthetics is clearly below the financial efficiency of MakerDAO. However, it gives you much more flexibility in minting various tokens. So now if you deposited SNX, you can draw a derivative, for example, a Tesla share, and you need an external price oracle that basically reports that basically can report, for example, the price of the Tesla share in with respect to the SNX token, and then you can get a number of representative Tesla shares. If you want to pay back the Tesla share, you can then unlock your collateral, which is the underlying SNX. So one really interesting insight in Synthetics is that if you want to now exchange, for example, this S Tesla into S US dollar, then the exchange mechanism, so to the process of exchanging the S Tesla asset into an S USD asset is simply a change of name of the actual asset you're holding, because the underlying assets are all represented by SNX. So this means that you can perform, and this is what Synthetics is offering, you can perform exchanges at zero slippage. because the underlying assets are actually not being exchanged. Hence, you have an ideal liquidity here between those two assets. Let's now dive into the third stablecoin example, which is Ampleforth. So that's a different mechanism. It's an algorithmic stablecoin where you don't need any collateral. So any idea how this could work without collateral? So maybe pause the video for a second or make a suggestion in the chat. So how could you create a stablecoin like a for example a US dollar representation without using any collateral? Well, the answer is that you can do this by simply reporting the US dollar price compared to a token, for example, the Ample stablecoin token to a smart contract. So you do have an external price oracle again. And there are three design states in your contract, right? So this is again here a smart contract that maintains the state of your smart contract. Of your asset. It can mint and it can destroy tokens, so these Ample tokens. And specifically, if the Ample price, so if one Ample is more expensive than $1, then you can add Ample supply, right? So you can increase the Ample supply here, right? So if you do increase the supply, then you're devaluing the remaining tokens, and hence it should exert a downward pressure on the Ample price itself. So you should be getting closer to $1. On the other hand, if one Ample token is worth less than $1, you need a contraction mechanism. So you need to remove Ample supply from the economy in order to make the Ample tokens more scarce, which would increase the price of Ample, push the Ample value of one Ample towards $1. And if one Ample is equivalent to $1, obviously there's no action that needs to be taken. So it's certainly quite an interesting stablecoin design or stablecoin proposal. The adjustment, so the particular adjustment here that's being done by the price oracle was set to be once a day. So this might be maybe quite a coarse-grained interval, because trading in cryptocurrency is happening 24 hours, but this was one of the design choices in Ampleforth. So you must think, or you should actually realize that the contraction here of an ERC20 token is actually something that's quite critical. So this could imply a systemic risk, so it has systemic implications. For example, if you do have an AMM pool, right, with two assets, X and Ample, in an AMM DEX, and it so happens that there's a contraction happening, right? Then this pool here is representing currently an AMM pool, or the price of an AMM pool is always defined by the ratio of the number of assets that are in this pool, right? And suddenly we're removing Ample from this pool because everyone is losing Ample, and so the price of this pool, or of the assets in the pool, will also automatically change, right? So which implies that there will suddenly be arbitrage opportunities, high frequency trading, etc. So this type of a design has quite some systemic implications on a variety of protocols that include this particular token. Voila, let's go to the fourth and fifth stablecoins that we're looking at today in this lecture. So these are USDC and USDT. So these are, I would say, more traditional stablecoins. They're reserve-backed stablecoins. So you do have a company which is performing full or fractional reserve. So I leave it as an exercise up to you to go into the legal agreements of these companies if you want to use these tokens. And the company basically mints at their discretion a certain amount of USDC and USDT. So you can see on chain how many of these tokens were minted. So I've provided earlier a screenshot of those two tokens, for instance, but you can go yourself on a blockchain explorer such as Etherscan or DBank, and you can identify how many tokens were minted by their respective contract. I want to draw your attention to a few further possibilities that these token issuers or stablecoin issuers can do. So, for example, both USDC and USDT operate a functionality, a blacklist functionality within their smart contract. So they have the option to add any arbitrary blockchain address to a particular blacklist. Once you're on the blacklist, you can no longer move your assets from this particular blacklisted address. So because the contract is basically blocking these assets. Now USDT goes a little bit further. USDT has a function to destroy coins at a particular address. And we have looked at past blockchain data, and we found over 400 accounts that were blacklisted, representing a little bit more than 44 million USDT that was zeroed out on blacklisted accounts. So please don't trust me and don't trust my word. Always verify yourself. So you can go to the USDT smart contract, for instance, and you'll find here a particular function which is called add blacklist, where you can provide a specific address. This is okay, it's only the owner that can do this. So here this is an access control modifier that would not allow anyone to call this function or to execute that function. So if somebody is then blacklisted, they will be added to the blacklist. Now USDT, as I mentioned, can go even further. So if you want to destroy the blacklisted funds, you simply need to provide here the address of a user that's already on the blacklist. And again, it's only the owner who can actually call this function. And the contract will sort out the number of dirty funds, and then it will actually zero out the balance of this particular user. So such blacklist and zeroing out functionalities are obviously a major concern in DeFi stability and the non-custodial properties of blockchain in general. Therefore, I would like to compare on a high level how a DeFi bank run could look like when compared to a CeFi bank run, so in a very simplified setting. A CeFi bank run is basically dangerous if a bank is operating in a fractional reserve setting with a very low ratio of assets in custody. And typically what happens if there's actually a CeFi bank run is that most clients either don't receive any assets in return, or they become a constant, very minimum back from the bank. In a DeFi bank run, so in decentralized finance, if there's an event such as USDT blacklisted pool, so this can be, for example, a Uniswap pool, it can be an Aave pool or a Curve pool, right? So if any of these pools basically are blacklisted, this means if you have, for example, if you have a USDC and a USDT pool, right? So you have an AMM pool with these two assets, and now suddenly the address of this pool is blacklisted, so it's no longer supposed to be able to send out assets. Then nobody can trade can send out the USDT of this contract, right? So this contract, the pool contract here, can no longer return USDT. They're locked in this pool. So what will happen is that everybody will try to take out USDC. Now what's interesting is the traders, they will exit the pool, right? But those who exit first, they receive the best prices. Because if we assume that this pool is perfectly balanced out, 50-50, and you take out like a small fraction, let's say, of USDC, right? And then let's say then 49% USDC and 51% USDT left, right? Just for the sake of example here. Then your price that you get, because you will be paying LP tokens to the pool, and the pool will give you back USDC, Right? This is the way that you can exit the liquidity pool. Now, if you simply move the pool from this state to this state, then you will likely get a very good price for your USDC. So probably 1-to-1. However, if you're the last one to exit the pool, so if there's only 1% USDC left and there are only 99% USDT left in the pool, then the slippage formula of this pool will make it extremely expensive to retrieve the remaining 1% from the pool. Because these pools, they always want to incentivize people to balance the pool automatically. And therefore, those that come last will receive the worst prices for exiting this pool. So it might just be not worth it to even exit from this pool. So therefore, high frequency trading is again of quite of an importance, and I'm sure that professional companies already have built detection bots for the case that if a liquidity pool that you're invested in is being blacklisted, or there's a transaction on the memory pools on the network layer propagating that will blacklist liquidity pool, you should basically directly and automatically issue an exit transaction from these particular pools. Thank you very much for your attention. I hope this gave you a good first overlook of what stablecoins are and what's the potential varieties of stablecoins, which will go much further in detail in the next lectures. Please don't hesitate to ask any questions if there's anything unclear.